Hey everyone. When I last recorded, I was talking about how my investments are primarily made up of one portion really buy and hold stocks, just holding for the long term stocks that I have strong conviction in. It's a whole assortment. And then also supplementing the buy and hold is trading options. And then I take the cash that I earn from that options trading each month and then I reinvest it into the buy and hold positions that I have so that the unrealized returns can compound. So I thought I would spend a bit of time to focus on how I view options trading. I just want to show first, like last year, you can see the chart. This is how the breakdown was of the different trades that I made. The vast majority were in short puts. I'll elaborate a bit more on what these different kinds of options trades are: short versus long, and put versus call. And but the main point is the reason I'm focusing more of my talk around short puts is because that's where I did most of my trades. And also, you can see like the prop in terms of my realized profits, the majority of the profits by the time you get to the end of the year are via the short puts as well. So that's just to give you a bit of context as to why I'm spending more attention in that area. Four scenarios here we'll talk about, right? And I'll just make some definitions because I realize some people may not know what we're talking about when we talk about call options and put options and longs and shorts. Why would you have contracts? It's because you get to lock in a price. Someone buys a contract because they want to lock in a price. You want to lock in the price of that stock. So a call option is a contract that gives the holder of the contract, the owner of the contract, the right to buy shares from someone else. Okay. Long means you're going to buy, you're going to purchase that contract. Short means you're selling that contract. So let's talk about the long call, for example, for the first scenario. So why would someone want to buy a call option? Perhaps I think the stock price is going to go up higher, and I just want to lock in the price of of the stock that I could buy it at. So we call that the strike price. I would pay someone a fee, a premium, we call it, some amount of money, and then the agreement we have with each other is I get to buy 100 shares of that stock from the other person at a certain price we agree upon. But we're also going to set a date, a deadline. Let's just say 30 days from now. And and I get to exercise anytime between now and 30 days. I get to exercise my rights and force them to sell me that Amazon stock at whatever price we agree upon. Now, I can exercise at any time before the 30 days, but it doesn't make sense for me to exercise the contract if the price of Amazon is below what we agree upon as a strike price, right? Because I could just buy those shares on the stock market. So that's what a long call option is. I'm paying someone else a premium for the right to buy those shares from them at a certain price we agree on by a certain deadline, let's say 30 days from now. On the flip side, maybe that other person, my friend, I'll sell him that contract. I'll collect the premium and then he pays me a premium. And now anytime between now and 30 days, he has the right to force me to sell him 100 shares of Amazon stock. So that's a short call. I've sold the option, I've sold the contract to someone, and they get to exercise it. Now I'm obligated to fulfill their order, give them 100 shares of Amazon. On the flip side, a put option is compelling someone to buy the shares from them at a certain price. Let's say I have 100 shares of Amazon. I want to pay someone a fee, and that gives me the right to sell my shares of Amazon at a price that we agree upon in the strike price, and let's say 30 days out. I would do this if I think the price of Amazon is going to start dropping farther and farther, and I want to lock in what my floor price is. So that's a long put option. I've given my friend the money to for the right to sell him my shares. So short put option. Okay, this is where I spend most of my time. This is where we'll dive in a bit with an example using Amazon in a few seconds. I will collect a premium for my friend because I sell him the option. Now that gives him the right to sell me 100 shares of Amazon at the price we agree on, the strike price. So if the price of Amazon drops down and it hits the strike price or goes below, he can exercise the contract, force me to buy the 100 shares from him. So let's look at the example of Amazon that we're talking about. I'm showing the graph. This is not real time. I just took a snap of Amazon a few hours ago. And you can see what the current price is at $229.66. This is a 3-month graph. You can kind of see where it was from 3 months till today. The general gist of this is, if you look at this chart, you know what Amazon is. It's a strong company, blue chip. Generally, like if you look at this, I mean, stocks go up and down. Like I captured a 3-month window, but if you look at different times, it does go down sometimes. But over the span of many years, it's generally gone up. And we talked about options having expiry dates, and the arbitrary date I just sort of selected for this conversation was about 30 days out. The benefits I'm getting here, if I sell a put option, is I get to collect that premium. The downside, the risk is, if I'm wrong on this trade and my friend gets to exercise the option, I have to buy the 100 shares of Amazon. And you look at the price of Amazon, that's like
100 shares times maybe $200, $20,000 total.
or let's say it goes 20% down. So maybe it goes down $40. So it goes actually down to $190. Doesn't happen all that often. If you look at how often those kinds of drops happen, they don't happen that often. But they do happen, sure. Now, let's say I want to set a strike price of $190. How confident am I that the price of Amazon is not going to drop below 190? Okay, I'll say in this example, I feel okay. So I want to set my strike price at 190. And I said 30 days. I'm thinking 30 days. I usually, when I sell options, I think about a 30-day window. So then, now the next question is, if the price drops down to $190, do I think that that price is gonna go below 190 and also stay below 190 from now to 30 days? Now the general rule of thumb I take on this is that when stocks go down 10%, 15%, 20%, which doesn't happen that often, there tends to be a bounce back. So if in the next 1 or 2 weeks, like Amazon were to drop 10%, you might see over the next few days it gradually climbs back up. Will it go back to 229? Don't know. Will it go there eventually in the future? Plausibly. And if I feel confident that it won't drop, and even if it does drop, it's not going to go past 190, or most importantly, that by the end of 30 days, it's not below 190, then maybe this is a candidate for me to sell a put option. Let's say you want to short it. You believe it's going to go down to 200. Maybe it hovers along 229 for months, and then a year from now, it goes down to 200. Okay, so then you can buy back, and then you have a winning trade. So whether you go long, whether you go short, that you can be right. Now, here's the thing is, if somebody wants to do this with options, maybe you buy a put option because you think the price is going to go down, or you buy a call option because you think the price is going to go up. If you're that person buying the options, you have to be right, like we mentioned the directions, but you have a time limit, 30 days to be correct. So if somebody was to buy that put option from me, and they think that the price is going to go down to $190 per share or below, then okay, they could be right. If it goes below, they're right. They also have to be right on time. They have 30 days to be correct, and if they're not, the contract expires worthless. So I've collected that premium, and that cash is now my realized profit. And that's the gist of why most of my trades have been short puts, and that's also why most of my profits have been short puts. There's more for me to elaborate on the different things I have to consider when you take on this kind of risk, and how you manage the risk. And I'll dive into that in different videos. But that's the mechanics of how I approach selling cash secured puts. Where I'll leave you off with is the worst case scenario, obviously, that we have to get to is I can be wrong, meaning it goes below 190, and at the 30-day mark, it's still below 190, meaning I'm now on the hook to buy 100 shares of Amazon. Number one, I need to have the capital ready to buy those shares. Two, I better be comfortable that that's a stock I'm comfortable holding at that price. So let's say that happens, right? Now I'm holding 100 shares of Amazon at $190. It's gone through a big drop, 20% within a 30-day period. Am I comfortable buying Amazon at $190 when I see right now it's at $229 because for some reason maybe there's some news and it dropped? I would say yes. Amazon is one of the stocks that I hold in my buy and hold portfolio. So the rationale behind this is I would get assigned the 100 shares, and then I would hold it and wait for it to go back up. So the idea would be I wait till the shares of Amazon go above 190, maybe like 191, 195, sell the shares, collect a bit of profit, and then I would have the cash back and the liquidity to sell more options. And so that's how I manage that risk. Actually, just going back to the profit by trade chart, you can see that that next area of profitability, the green blocks, that's longs, meaning that's the stocks that I held and then sold. That's the reason why that's the next most profitable trade that I have. They're actually an extension of the short puts. I've entered trades where the price had fallen for a stock. I ended up being assigned that stock, was holding it, and then was in a position to wait and eventually sell at a profit. Okay, let me know if you have any questions. And if you're finding it useful, appreciate if you like the video. It gives me an idea that this is the kind of stuff that makes sense. If you have any questions, type that in below. Then I'd like to, if there's any dialogue to start, that'd be great. I think, as I mentioned in the very first video. So I'll talk to you next time.